European stocks are back in business, but can it last? Over the past decade, capital has flowed from Europe to America in pursuit of better returns, but now the trend has reversed. European shares are enjoying their strongest start to the year since 2000 relative to US stocks. But a costly US trade deal is starting to become a reality. So is there still potential for a further European outperformance? Benedicte Lowe is equity derivative strategist for Europe at BNP Paribas. So Benedicte, trade deal jitters have significantly weighed on German investor confidence. What sectors are going to be taking a hit from the current trade deal with the US?
Yeah, so we've seen actually a quite more nuanced and a mixed result in reaction of the market to the trade deal that has been announced between the US and Europe. Basically, we were almost flat before this morning, and today we've got a decent rally that is kind of helping in terms of sentiment. The reality is that the market, I think, is ready to focus on another subject. That might be the German fiscal stimulus that is upcoming for the end of the year. That might be hope of a potential peace deal in Europe between Ukraine and Russia, or even the next earnings season. I think the market's ready to move on. Now, at a sectorial level, we've seen different types of performance, of dispersion. We've had some sectors that were more impacted. Those are more US-driven and more US-exposed sectors. So the pharma is the first one we have in mind. There was the impact from the pharma tariffs that were announced, but also there's some fears that Trump will impose lower drug prices. That would be a net negative for the sectors, but also other sectors such as food and bev, the luxury sectors that have been a bit more impacted by the trade negotiations that have been ongoing.
Well, you mentioned the earnings season and results have been overall quite poor in Europe. Should we expect to lower expectations for the next quarter, especially with a stronger euro?
So we've had indeed quite a disappointing earnings result in Europe for this earnings season. I think now expectations have been revised lower. That also means that the bar to surprise at the next season on the upside has been actually lowered recently. We also have to take into account that, as I mentioned, we're going to have some fiscal stimulus in Europe that should be positive for the overall growth of the sectors and of the European regions for the end of the year. So I think it's kind of too early to say. I think the market will probably try to guess where also the growth picture is in the US before having too much of a view around the next earnings season that is in a couple of months' time.
Meanwhile, defence stocks were the hottest sector during the first half of the year, while hopes of a peace deal between Russia and Ukraine are starting to grow. What does it mean for these stocks?
We've seen strong performance of the defence sector after the EU defence plan was announced this year. And at BNP, the defence sector remained one of our long sectors. We keep our long bias. We've seen that inflows have continued on the sector, so momentum is actually quite supportive for that sector. Now, the reality is that given the outperformance that we have this year, stellar performance of the sectors, we think positioning on the sector via options rather than futures makes a lot of sense. That can protect investors, so for some potential downsides, we think switching out of futures into options is the correct way to go on that sector.
Falling interest rates were another tailwind behind Europe's outperformance this year, but markets aren't expecting another cut till December, likely to be its final move. Will this weigh on European stocks?
I think on that question, we need to take a step back. And when we look at the current level of the 10-year German bond yield, it's trading currently at around 2.7%. If we compare that to the equity space, where the earning yield, which is the inverse of the PE ratio, is trading at around 7%, that still gives you a good premium when you invest into equity market, into the riskier part of the spectrum versus the safe asset, which is the German bond. So I think based on that, the picture for equity market continues to be quite positive in Europe. And also we have to keep in mind the fact that if for whatever reason the European Union was to be hit with a negative growth shock, the is probably able to cut rates from the current levels that we are at. So I think the rates picture is less of a concern in Europe versus where we are in the US, given the level of valuation that are very extended in the US market.
So finally, Benedicte, Barclays have recommended buying dips in European stocks as there is a case for them to end the year at a record high. Do you agree?
Yeah, so the picture in the European equity space is that earnings, as you mentioned, have been disappointing, but the market has been detaching from that. And the main reason we think is coming from the fact that positioning is low in European equities, especially after the NFP sell-off that we had in Europe. All of the systematic type of positions, such as the CTS, the vol target, they've unloaded some of their exposures. Once the realized vol normalize, which is happening at the moment, we see room for those strategies to reload, and that should help positioning within Europe. We also have, as we mentioned earlier, the fact that there's some hope of a peace deal between Ukraine and Russia that could lift sentiment on European equities, and that actually would be the most kind of convex scenario into Europe. So probably what to have in mind is that pain trade is to the upside, the overall market is underinvested, and there's some shock absorber at the moment in the European equity space.
That was Benedicte Lowe from BNP Paribas. Don't forget, you can watch more videos on Reuters.com.